What's up, YouTube? I am here up in the mountains of Colorado where it's so high up I'm having trouble breathing. I mean, they literally sell O2 oxygenated cans, the supermarket for you to, in case you're having issues. And visiting some friends up in the cabin. Sorry, I'm in the basement again next to the washer and dryer, but you guys don't care because all you care about is what I'm about to say about the markets. Hope everybody's having a blessed 2025. And let's get straight to it. So today we're going to be talking, as I showed in the thumbnail, what is going on with the dollar. And look, the dollar is just going berserk, right? So here's a long-term chart of the past few years of what the dollar has been doing. This is the DXY, so it's a dollar against other currencies. And you know, the last time it went up and it spiked was right around 2022, where it peaked a little past halfway of the year. And if you recall what happened back then in 2022, I mean, we went down, right? The markets, that's when we had that huge correction, and it ended basically a little past halfway point, which is basically when the peak was reached, and then the dollar came crashing down. And it did that, and it's been like basically in this range between 99-ish and about 100, 6-ish. And it's just been bouncing like ping pong in this range for a few years now, right? But what has happened is that we have broken through that resistance. So now we have gone above that range and about to shoot up higher. Now, this needs to be carefully monitored because it's very counterintuitive, but a strong dollar is not good, right? It's a bunch of things that can happen with a strong dollar, and it looks like we're heading that way. And what that means is, look, we are at record levels of divergence from fair value, meaning like how overvalued basically is the dollar. And we are today right here, right? So that should give you a sense of basically how overvalued the dollar is and how everybody's like reaching for the dollar. And one has to wonder, why is everybody scrambling for the dollar? Why, we all know the dollar is a fiat currency and it's being, printed to death, but why is it so strong relative to other currencies? And if you look at what's going on with other currencies, I mean, the Indian rupee has been like, it's like dying, right? It's at its lowest. I mean, to the dollar, it's been dying. And then, if you look at the Korean won, it's again dying. It's, lows we haven't seen in many, many years, decade type of activity. And it keeps going on, right? Look at what's going on with China. Wow, dude, that is a crash, right? The Chinese government bond yields have completely collapsed. And this is a dangerous thing. This is not good. Something is going to happen out of this if left unchecked. And make no mistake, the Chinese government is going to intervene because this can't obviously go to zero. But what do you see in all these charts that I'm showing you? Like China, India, Brazil has also been collapsing. I mean, basically, the currencies around the world are going basically to the ground, and it's like a toilet flush and a race to the bottom. And there's a bunch of things going on as to why. And one of the things that you need to keep in mind is there's a geopolitical reason and a multifactorial decoupling of the global basically economy, right? The globalization of the world is being slowly unwound. And what used to be the case where everything was interconnected, it's a dollar system and the financial system is now, there's like the BRICS plus system. It's no surprise where some of the BRICS nations are having these currency collapses, including the Russian ruble. And that unentangling of the global, basically globalization of the financial markets is causing some chaos, right? And that's what's going on. So this is not going to be like, it's resolved in like one day. This is going to be like a multi-year unentanglement of the global financial order. And during that period, what we're going to see is essentially accidents. It's going to be messy. It's not going to be a perfect unentanglement. And in this messiness, whenever there's a messy period, along with accidents that are going to happen, you're going to have the dollar shoot up, right? Where everybody's scrambling for the dollar. Now, the typical, if you go online and see, well, why is the dollar so strong? They're going to give you the generic answers of, well, the U.S. economy is doing well. Okay. And the second thing is, to some degree, correct, which is that the Fed is being a little bit hawkish now, right? Remember, Powell came out and started saying about maybe they won't be cutting rates as much as the market anticipated. That caused that, that kind of mini flash crash some weeks ago. So people are saying that's the mainstream media understanding of why the dollar is, so powerful right now. But there's a lot more going on, and it has to do with the basically unentanglement of the global financial system. And in there, we're going to find ourselves having some accidents. We saw one earlier last year. Remember with the yen carry trade unwinding? Look, every great financial crisis has some form of currency carry trade unwind. Basically, these big players get smart and they use the exchange rate differences to basically, magnify their profits, basically, to put it short, and they lever up on that. And so whenever there's like some rift or some sudden like crisis that comes calling where they're unprepared for the unwind of it, you'll have a carry trade unwind that goes berserk, which is, we got a taste of it with the yen carry trade unwind last year. Now that we're in 2020, late last year. And I expect there to be more of these type of accidents lurking in the corner, but we have to be very careful of these currency market gyrations, right? Because the biggest market is bigger than the stock or the bond market is the currency market. That's the biggest market. It's the most liquid and largest market, and that's where if something happens and there's a trouble spewing on it, we're going to have serious issues to deal with. So moving along here, the next thing I wanted to show you was an interest. So this was pointed out to me by somebody, and I thought I'd share it with you folks as well. And it's essentially a recession indicator based on the Chicago PMI, or the manufacturing index. And what you see here is basically every time it goes beneath this dotted line, right, we've had a recession, and we've hit that, right, this time around. We've gone under 40, and you would see every time we go under 40, we have the gray bar, which is the recession. Now, and it's been pretty accurate. I mean, this goes back to 1971, so we're talking like 50 years of data here, and it's been pretty darn accurate. Now, one thing I will say is, I don't kind of like drawing an arbitrary line, and then saying if you go over it, something's going to happen. So, a little caution to that. But nevertheless, looking at this, I can tell you, it's another nail in the coffin, basically. And if you look at my earlier videos, I have all these other things that I've been macroeconomic indicators that are signaling an incoming recession. Well, this is just another one to add to the equation, and something to keep in mind as we go forward into 2025. The other thing to add on to that at a macroeconomic scale is basically, whenever the Fed, this chart is really important. It's telling you the Fed, action of raising rates and cutting rates. And you see in 1980 went all the way up to 16%. And then you'll also see in the blue line, the federal debt as a percent of the GDP. So basically how much debt we have compared to, the GDP that we're making, right? And the last time was right after World War II, when the US got into huge amounts of debt to fund World War II, was this high. We've actually surpassed that. So the amount of debt that the country has is actually greater than in World War II. Well, this time there's no war. There's no World War. There are wars, proxy wars, but there's no World War III yet, even though many will claim, and I kind of believe them, that it's already started. And when history is rewritten in the future and looking back upon today, you're going to say it already started at this time, just didn't know of it. Kind of agree with it. This is what Ackerman was saying, the hedge fund guy. And I kind of agree with him. And so, yeah, look, we're at huge debt levels without the war even starting. And, at the end of World War II, there's a huge boom in converting the economic machinery back from a wartime economy, making missiles and bombs, to an economy making products and services and goods for the consumer. And that caused this, growth of the debt to drop. Well, we didn't have the war, right? And so what's going to cause this to drop remains to be seen, right? And especially if we do have a war, how are we going to fund it? I think it's a good question, right? Where are we going to get the money to fund a World War III when it happens, if it hasn't already started yet? Now, you can see we've had this major rise in rates and now a cutting cycle. The last time we had it was this little blip of a gray line here during COVID, and all the other times whenever we rose rates and cut, we had a recession. Why do we have recessions when we raise rates and then cut? Well, basically the Fed always screws up, right? This is basically their track record of how good they are, right? They raise rates and they cut them, and what happens? A recession happens, right? So no, they don't stop recessions. Look at their track record. Every time we raise rates, cut it, raise rates, cut it, raise rates, cut it, raise rates, cut. Recession follows. So yeah, no, they kind of suck. That's just the data, right? Don't take me for what I'm saying. This is just report card of the Fed, if you will, is this. And look, the report card is saying they're going to blow out again. And yeah, I believe they're going to blow out. And I showed you in my earlier videos other metrics and yield curve uninversions and blah, 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 that shows you that this is coming. Well, this is just one more, another look at this, basically the same thing to just seal in the likelihood that we have an inbound recession at our hands. And most people, including most of the market players, are not positioned for it right now. The other thing I just wanted to, again, I've shown this before, but just to reiterate, is the concentration of the stocks into just, of the money rather, into just a few stocks, right? The Magnificent Seven and blah, blah, blah. I showed you different looks of the same thing. Here's another look of the same thing. Like this is just relative to 75th percentile stock, top 10 stocks to S&P. And it's never been higher. Actually, I don't know if we've actually surpassed the Great Depression, 1928, 29 was when every, like shoe shine boys, you know, shoe polish boys were investing in the stock market. That's how big a bubble it was. Everybody was in the stock market thinking they're going to be millionaires. Kind of similar situation. Everybody's in the stock market thinking they're going to be millionaires. And they're all concentrated into just a few stocks that everybody's talking about, right? Today it's Nvidia, blah, blah, blah. Back then it was their version of today. Dot-com bubbles another time when everyone's talking about, oh, the internet's going to change everything. And, you know, we're all going to be bazillionaires. And everybody was into like Cisco and, you know, pets.com and blah, 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 Akamai. So, you know, the hype concentrates it into a few companies and their stocks. And that's what you get in this chart. You'll see the concentrations. And every time you get like very concentrated, bad things happen, right? GFC, COVID pandemic. And now I don't know what you want to call this, call it the everything bubble. But we are mad, compressed and concentrated right now. And obviously that's not going to continue, right? There's always going to be some kind of mean reversion. Could this go higher? I mean, technically, yeah, it could, but we're already so concentrated. I mean, there's not much more to squeeze higher, right? We're kind of there. And even if we're not, there's not much more room up to go. And when you're that concentrated one side and the rubber band breaks and you go back down, well, I don't need to tell you what's going to happen. I'm watching that very carefully. I've been saying this for a long time now, but the interest rates keep going higher. The Fed started cutting, and all it's done is gone up. Now I'm showing you this chart because we are today, right now, at a very, very make or break level. We are at the previous highs, right? Last time we hit this back in May, it came back down. We're there again. Now we hit it once, right? We got hit down, but we're back up again, right? Last time we hit it and we got battened down. But here we are, right? Again, right there. So if you look at this, it doesn't look like it's going to go back down, right? It looks like we're probably going to break through here along with the dollar, which has already broken through. Right? The dollar and the bond market are telling the Fed the same thing. And they're also telling the stock market, the dumb money, the same thing. And they're going to catch up soon. But they're telling the same thing, right? Interest rates are going to be going higher because there's going to probably be more inflation that's coming up. And the dollar is going to continue higher because there's this decoupling going on in the world with the global financial markets. So these dynamics, these are very like long-term macroeconomic dynamics, and they're moving the markets, right? And they're moving it in a way where it's not like your typical day traders watching this stuff. This is the stuff that like, you know, macroeconomic analysts at like the government level and like these multilateral institutions are watching along with me and now you. And so because this has already pierced through, meaning the dollar, I kind of believe that we are going to pierce through the resistance made last year in May in the bond market for yields. And what that spells for is obviously trouble in the stock markets, because when yields go up, interest rate sensitive stocks go down, particularly the NASDAQ. And I do think we're going to go up. I don't think this is going to be battened back down for good. I think we may go down and go back up, but whatever the case is, we are probably going to head up following what's going on with the dollar. All right, I want to just spend a little bit of time, talking about gold here, right? And so one of the things, this is an interesting North Star bad charts. I love these charts. Look, I don't have to make all the charts myself. If people make good charts, I share them with you, right? And give them credit for it. So North Star Bad Charts made this in 2022, actually. So this is like an old chart, a couple of years old. And what they were talking about here is the gold versus SPX ratio. And basically, when that ratio, goes to 1, it's in equilibrium, right? Like 1 ounce of gold is the same price as the S&P 500, essentially 1 to 1. And we've had it overshoot in the past, right? This is just data going back to 1924, so 100 years of data, okay? So that's a lot of data. So we can look at this stuff and say, like, look, we've had overshoots in the past, right? Back here when it did this, I remember gold was basically behaving like Bitcoin. And yeah, it was a bubble. People were buying gold because of its currency attributes and store of value. People are buying gold just to get rich, right? And that can happen to any asset class, including gold. It's happened in the past. And that's what it is with Bitcoin today, which is why I don't put too much of an allocation into it, because it's kind of, everybody's trying to get rich scheme going on right now. But if you look at it, we are at 0.480, right? And they were saying, like, look, if we hit 0.50, right? If we go above 50% FPFL, then we have a breakout and it's a new cycle. Well, 2 years ago, they were saying this. Well, 2 years later, we totally broke out of that and we're above 0.5, right? And so that means we are most likely going up. Again, how high up? I don't know. But we are definitely in a secular gold bull market, which is what I've been telling some of my followers. Like, we're in a secular gold bull market and position yourself for that, meaning like it's a bull market that's going to go on for many years, right? Even up to a decade potentially. So anytime we have these corrections, even if the corrections last for months, they're just good entry points or discount windows to buy more at a discount, which is exactly what I'm doing, is accumulating. It's kind of buy the dip type of mentality, except instead of for equities, you're doing it for gold and at a longer time frame because it's a secular gold bull market. And I expect this to get, so what happens if the S&P and gold ratio goes to 1? Well, two things. You can get there in multiple ways. Gold just goes up, SPX just goes down while gold stays the same, or both SPX goes down and gold goes up at the same time. I think it's a third, right? Which is gold goes up and SPX goes down at the same time, some kind of a deflationary situation. And even though they talk about inflation and all that, like on the long term, we may face a deflationary situation, which the Fed has no bullets for, right? Deflation is the thing that scares the Fed by far the most. So I think we're heading there, and that's why I'm long gold and kind of short the stock market in the long term, even though I play long the stock market for short-term hits on the upside, because I do think we still are going to hit possibly a blow off top and a new all-time high in the markets before everything comes crumbling down, but we're getting very close to that. So speaking of that, I just want to show you how I'm positioned. So, if you look here, this has been the stock market in the past few days. We're in this downtrend channel. This is S&P 500. We look like we're trying to put in a double bottom here. If you look at this, right, we're trying to do a double bottom bounce, yet at the same time, we did make a lower high. So we also have this descending, wedge pattern, descending triangle. So we're at the resistance here in this line that I've been watching. Last time we got battened down, was acted as support, broke through it, was resistance, and it kind of stalled at resistance on Friday. So the question here is, what are we going to do at this resistance point? Are we going to go down from here because of the resistance and start doing this bouncing around in this range? Or we're going to shoot above it and test this descending resistance line over here. And the question is, we don't know, right? We don't know. Chances are we're probably going to have more downside, right? Because even if we don't go down here and go up and retest this, we're still in descent from a TA point of view in descending triangle with, in the longer term, you'll see that we have divergence down here on the weekly, which is, this does not look good, right? Like, we keep making higher highs with lower and lower RSI tops. Not good. This is going to resolve in a bad way. Is it going to be now? Is it going to be a couple of weeks from now? That's the part where we don't know. That's why I go into shorter time frames. And in the shorter time frames, what do we see? We see this pattern emerging. So something I'm closely watching. As of now, I just left my long volatility play. I also went short the Russell 2000 with a smaller point, just to mix it up a little bit. So I'm net short right now. And because I did make quite a good amount of profit earlier, I have buffer to lose out. Even if the stock market goes up, I'll still be up. net. So, you know, I have wiggle room, and I don't want to basically miss the next move down, which could be a pretty strong move down. So that risk of it going up here, it's okay. I can stomach that because I made profits. Now, if it goes up here and it blasts through it up here, I might close my positions and flip long and try to go for a ride up to the new all-time high. And then from there, we see we're a good entry point to position yourself for the correction and possibly a topping correction in the coming weeks. So, you know, having said that, you know, just be nimble, stay alert. Know that there are huge macroeconomic forces coupled with geopolitical situations like BRICS Plus and all this stuff happening that are driving the market. It's the stuff that you see at the top that traders and day traders like to talk about. I mean, yeah, you know, it's good for scalping and doing little like things here and there, but you know, understanding the underlying movement that's going to make the big changes that we see where you can make the big money is critical, because you don't want to miss it, and worse, you don't get hurt by it and go broke. So we'll see how this goes. I'll keep posting updates as we make money on the way up, but position ourselves for the big move down. Having said that, I'm going to go out into hopefully the snow out here in Colorado and enjoy some of the powder. And I'll see you guys in the next episode. Peace out.